Okay, in this video we're going to go over the journal entries that the seller of inventory has to make. So in this situation you have to put yourself as the accountant of the company that is selling inventory to one of its customers. So you're either going to have a drop-down list. So in here where you put the account titles, you'll have a drop-down list with all the account titles that you can use, or there'll be a chart of accounts down here at the bottom for you to use. And make sure you're using the exact same account titles as what's in the chart of accounts or the drop-down list. Okay, so the very first transaction says on March 5th, ABC Inc. sold 500 units of product at a sales price of $35 per unit. So we sold it to our customer, 500 units at $35 per unit. So that's going to be the sales price. Terms of the sale are $210, net $60. Whenever you see this, that means we've sold it on a credit, which means it's we're going to be sending a bill, and it's going to be accounts receivable. We sold on credit to a customer. That's always accounts receivable or notes receivable, but 95% of the time it's going to be accounts receivable. The invoice is dated March 5th. The inventory cost ABC Inc. $20 per unit. So when we bought it, when ABC Inc., our company, bought this inventory, it's sitting in our inventory account at $20 per unit. So whenever a seller sells merchandise, there's always two journal entries to do. You have to record the sale to the customer at the sales price. In this case, it's $35 per unit. And you have to move the cost that those goods cost us when we originally purchased them out of our inventory account, because now they're no longer ours. They're being sold to a customer, and into our cost of goods sold. Okay? So the very first thing we have to always do is record the date. It's March 5th. And the first thing we're going to do is record the sale. And again, it's a sale. So we're going to be increasing our sales, which is a revenue account. So that's going to be the credited accounts. That's always going to come last in a journal entry. The debited account is going to be accounts receivable. The customer didn't pay us cash right away when they bought us. We're billing them, and that we're giving them 60 days to pay it. Or if they pay it within 10 days, we're going to give them a 2% discount. That's what that 210 net 60 means. So accounts receivable is an asset, and so we're increasing that asset. The customer owes us money, so we have to put that on our books, and they owe us 500 units at $35 a piece. That was the sales price. So they owe us $17,500. And then we're going to increase our sales. Sales is a revenue account, and in order to increase that, you have to credit it. Okay, so we're increasing our asset accounts receivable, and we're increasing our revenue account sales. Remember, there's two journal entries here when you sell goods. So we're also on March 5th. You don't have to write the date again. You can if you want to. We're also going to take those same 500 units out of our inventory at the original cost to us of $20 per unit. We're decreasing our inventory. Inventory is an asset, so we know that to decrease an asset, you have to credit it. So that's going to be the second account. The account we're going to debit is cost of goods sold. And sometimes that is abbreviated COGS. Okay? And that amount is going to be the 500 units. Oops, not 5,000, 500 times the $20 that inventory originally cost us. We have to take it out of our inventory at what we actually put it in there at. Okay, 500 units at $20 a piece, so $10,000. And we're going to decrease our inventory by that amount, because now we've sold it to our customer. It's no longer in our inventory, and it's going to be the same amount. So when we get to our income statement, we're going to have revenue of $17,500. minus the cost that it cost us of $10,000, so we're going to have a net profit of $7,500 on that inventory that we just sold. Okay, so this is the cost of the goods that we sold to the customer. Cost of goods sold. It's exactly what the account title says, right? Okay, so now on March 7th, it says the customer from the March 5th sale, which is this one up here, returned 50 units and received full credit. So for whatever reason, they could have been defective. They could have just ordered too many. I don't know exactly what happened, but anyway, they returned 50 units to us, and we gave them full credit. So we have to reduce the accounts receivable. They're no longer going to owe us for those 50 units that they're returning to us. And the first thing we have to do is put in the date, March 7th. And when a customer returns goods to us, we're not going to debit the sales account to decrease it. There's a special account that we keep track of because we want to know how much customers have returned to us. So there's a special account called Sales, Returns, if I can spell, and Allowances. We want to keep track of all of our returns and allowances. So in order to calculate the amount, it's the 50 units they returned times the original sales price. We're giving them full credit of what they purchased from us. So not the $20 it cost us, but the $35 we sold it to them for. And we're also going to reduce that accounts receivable, right? They're no longer going to owe us this full $17,500. We're giving them a credit of $17,050. So accounts receivable is an asset. In order to decrease that, we have to credit it. Then we also have to put these 50 units back in our inventory. And this original entry, we took it out of our inventory, but now they're returning those goods to us. We can turn around and sell them again if they're not defective. So again, you could put the March 7th date down here again, but you don't have to. And inventory is being put back into our inventory, so we're increasing an asset. So that is going to get debited. We're not going to put it back at the $35 we sold it to them. We're going to put it back at what it originally cost us. So the 50 units times $20, what it originally cost us, we're just putting it right back in. So that's $1,000. And we're going to reduce that cost of goods sold because now those units were not sold. I'm just going to abbreviate here. Those units were no longer sold, so they should not be included in our cost of goods sold anymore. Okay? So they returned 50 units. We gave them credit on their accounts receivable. They no longer owe us that amount. We debited this special account called Sales, Returns, and Allowances, and that will be netted with our sales account when we prepare the income statement, and that'll be in the next video. And we reduced our cost of goods sold, and we put that inventory back in our inventory amount at the original cost. Okay, now on March 15th, the customer is going to pay us for these 500 units less the 50 that they returned, so the 450 units that they still have. So on March 15th, we have to record the journal entry that they're going to pay us money. And we have to do a little bit of calculation, right? Because we're within the 10 days of discount. March 5th was the date we sold it to them, and they're now paying us on March 15th. That's on the 10th date, so they still get that 2% discount on our credit terms. So one of the first things we have to do is calculate what is the discount. So they originally owed us $17,500, right? We gave them a credit of $1,750. So they now owe us I did that calculation wrong. They now owe us $15,750, right? The $17,500 we originally sold to them minus the 50 units they returned to us. So they now owe us $15,750. So that's what the new discount is going to be calculated on. Okay, so if we take this $15,750 and we multiply it times 2%, because that was the discount amount, the discount is going to be $315. So they're going to give us cash, right? Because it says they're paying us. So cash is going to be received. Cash is an asset. So in order to increase an asset, you have to debit it. And that's going to be for the $15,750 they owe us minus the $315 discount, right? They owe us $15,750, but we're giving them a discount. So the amount they're actually going to send us is $15,435. We want to record that discount also in a special, sorry, I'm getting a phone call. We want to record that discount also in a special account. We want to keep track of how many discounts we're giving our customers. In case we want to ever increase or decrease that discount, we want to make sure that we're keeping track of that. And we've already calculated that amount. We calculated it's $315. And that's going to be debited. It's called a contra sales account. And so is the sales returns and allowances. So contra sales accounts are increased with debits. And we have to take this accounts receivable off our books, right? Because now the customer has paid us. And we need to reduce that balance back down to zero. So accounts receivable is an asset. So in order to decrease that, we have to credit it. How much are we going to credit it for? We're going to credit it for the $17,500 is what they originally owed us. Not $17,500. $17,500 they originally owed us, right? Minus the $1,750 credit we gave them. That's how much their accounts receivable is sitting on the books for right now. So that's what we have to credit it for. Make sure your journal entry is in balance, which means your total amount of debits and your total amount of credits have to equal. So if we add these two together, the $15,435 and $315, you'll see right here it totals $15,750, and that's what our credits are. Every single journal entry should have an equal dollar amount of debits and an equal dollar amount of credits. If it doesn't, you're not finished. The journal entry is not complete. It's not in balance. Okay? The very last thing we have to do is record what would happen if we, as the seller, had to pay the delivery cost. The cost to get those goods to the customer. Sometimes the customer is going to pay delivery charge. Sometimes we're going to pay the delivery charge as the seller. If the seller pays the delivery charge, let me just write the date here. It's March 18th. If the seller pays the delivery charge, it's an expense to the accounting records, okay, for the seller. It says on March 18th, we paid $55 for delivery of goods to the customer that purchased those goods on March 5th. So delivery expense, it may be labeled something different. Make sure you're looking at your chart of accounts and choose the closest thing. It could be shipping and handling. It could be freight charges, freight expense, anything in that nature, okay? And it says we're paying it. It's not on account. So cash is an asset. In order to decrease an asset, you have to credit it, right? Delivery expense is an expense. In order to increase an expense, you have to debit it. Okay? So those are the journal entries that you would have to make from the seller's point of view on the seller's accounting records when they're selling merchandise. You have to record the sale to the customer, and when you record the sale to the customer, it's always two journal entries. The sale at the sales price, which in this case was $35 per unit, and you have to take those goods out of our inventory now, because now they're no longer ours, and put them in cost of goods sold. Okay? All right, I hope that clears up any questions. And in the next video, we'll do a income statement for a merchandising company so you can kind of see these new accounts that we talked about, the sales returns and allowance and the sales discounts.